DLA Piper commissioned a global survey of financial services organizations across North America, UK, Europe, Asia Pacific, and Africa to explore disruptors in the financial services sector. We worked with Coleman Parks Research and conducted nearly 800 interviews in March and April of this year with key business executives from banks, fintechs, funds, and financial services market infrastructure firms with revenues ranging from 10 million to more than 10 billion. And interestingly, the survey identified a number of key disruptive themes. And it didn't matter in which region. It was fascinating that across the globe, the same themes came up: digitalization of financial services, AI, ESG, and related regulatory and litigation risks. And even amid these disruptive forces, the financial services sector on a global basis is feeling optimistic, with a high amount of optimism, 93% in the UK and 90% in North America, as the disruptors are being viewed as opportunities for growth, opportunities for innovation and change, positive change. The report offers, and you'll be able to get a copy of that report, it may be in the app, it offers insights on how all organizations, whether or not financial in nature, are seizing these opportunities for growth, and draws some conclusions on how businesses can best position themselves for now and into the future.
So it probably comes as no surprise to you that ESG was a major trend in the financial services space. That's something that companies have been watching for a good time period now, but it continues to evolve. As you may know, the regulation and legislation abroad, particularly in the UK and the EU, is much more developed than it is here in the United States. Very much in flux here, and of course, regulatory uncertainty produces regulatory risk, reputational risk, and litigation risk, and that's what our survey respondents told us. Over half of the survey respondents told us that ESG is the biggest challenge faced by the financial services industry, and 1 in 10 said that they are concerned about how they're implementing their ESG guidance. Almost 50% are deeply concerned about reputational risk due to ineffective positioning of ESG, and that's an important statistic that we'll come back to in this conversation, because in the early days, people rolled things out in a way that perhaps does not now match where the regulatory guidance and some of the litigation risk has matured. 49% in our survey said that they're having challenges in creating sustainable products, and 47% are concerned about integration of ESG throughout their business. Again, almost 50% of the respondents directly flagged regulatory uncertainty and complexity as one of their major issues of concern. And over half of them actually want to see, you never hear this in the financial services industry, more regulation around ESG because they need some guidance. And that is true whether you're surveying North America, Europe, Asia Pac, or even in Africa. And in the United States, of course, we have an additional complication, which is the political tension, the red states versus the blue states, and some very strong opinions on both sides, and companies having to manage both the reputational risk that comes with that and the challenges of complying with sometimes different directives. And we are now, particularly here in California, seeing very robust legislation around climate change, some of which is now playing into the financial services space as well, and some efforts by the legislature to engage in agreements with private industry, which are beginning to pave the way for other states to follow. So this is very much a space where things are continuing to develop. And at the same time, a lot of this legislation is asking about disclosures. And that is something that the plaintiffs' bar is going to be very interested in. If you're required to say what you have done, then you're going to be stuck with those disclosures later. So very much a sensitive area of emerging litigation, regulatory, and reputational risk. I can tell you as a litigator that class actions have exploded. ESG litigation has exploded over the last few years. A lot of it has been in the greenwashing space. I think that's probably the beginning, and we are moving out of sustainability and climate change and into other frontiers, including all 3 pillars of ESG. And there will be more to come there as those areas develop. 40% of the respondents in our survey are concerned about the accuracy of their reporting. That's the same statistic again, right? They're not super happy with what they've already put out there in the world, but they're going to have to deal with it. I think we will see more securities litigation in the space. That's an easy one. More consumer class actions in the space. more activist claims in the space. We see those both here at home and also abroad, where activists are trying to actually change the agenda by holding companies and sometimes municipalities responsible for the outcome of climate change. And particularly in the financial services space, there's a trend toward debanking, trying to choose a disfavored industry or even a disfavored company like the fossil fuel industry, the coal-fired plants, and then push on the insurers and the financial services companies that support those industries to withdraw that support. They can't put you out of business directly, but if they can withdraw your ability to have capital and insurance, it would have the same result. And then, of course, some pushback by states like Florida and Texas in that space.
So with respect to digitalization and AI, 71% of the survey participants believe that digitalization of financial services and products and processes will have a transformative impact on the industry as a whole. 66 believing that digitalization will provide the biggest opportunity for growth in terms of market share and revenue. The optimism is being driven by a number of factors: convergence of technology and innovation, market demand, and capital. With respect to innovation and technology, fintech companies, as we all know, continue to transform traditional banking and financial services. The innovation is in the delivery channels, online, mobile. You can do almost any type of transaction on that particular device, big or small, and new and interesting product offerings: embedded finance, buy now, pay later, earned wage access, electronic signatures and records for all kinds of consumer and commercial transactions, complex ones, carbon credits as collateral, all kinds of new, really super interesting products. And these are resulting in measurable efficiencies, cost savings, and customer retention. It's been some time. I mean, technology just didn't start yesterday. It's been 25 years anyway since the legal framework in the United States has been there. But finally, there's enough of an inflection point, a turning point. I'm not sure we'll say tipping point, but ROI is starting to really be measured, and companies are appreciating that in investing. With respect to market demand, post-pandemic conditions have continued to accelerate digital transformation. It has become the new normal, big boost. And with respect to capital, 6 in 10 firms are investing in technology, with capital infusion from private markets into AI being dubbed as the biggest spending boon in recent American history. Data center have doubled, investment is there as well. However, as there always is, there are a number of key challenges impacting the ability to digitize in a meaningful way. We're going to call it the not ready for prime time problem. There's always a time curve, again, not a new concept, in terms of taking underlying technology and turning it into meaningful solutions. The adoption lag is related to a number of things. You've got platform interoperability, whether the product is fit for particular purpose, whether it's designed to account for product regulation, whether the business is committed to spending money on legacy systems. And critically, when embarking, this is a common problem, when embarking on the transformation journey, the business should not boil the ocean. It really should consider what are the pain points. Where can we really get the biggest bang for our buck when we're going to transform and invest in technology, business process change? Gather the right team, internal team, external team. It really does take a village of compliance, legal, business, again, both inside and outside the institution. Understanding the build versus buy dilemma. And again, some of these things are not new concepts. They're still there, and we're encountering it every day with our clients. We're having the same conversation that we had 20 years ago. Companies want to build it. Oh, we've got the right people, the right IT, we're ready to go. But you know what? We want to get to market in 5 minutes from now. So it doesn't really quite work that way. So that conversation is still ongoing. What to watch for: scalability, licensing dependencies, third-party risk, kick the tires, don't just rely on reps. More challenges, people-related challenges, hearts and minds. Are they aligned? Are they committed to deployment? General counsels, lots of hand-wringing. Too much law, not enough law, there's that balance. Managing risk, getting comfortable with an acceptable risk in an environment that's rapidly changing. Or said another way, figuring out how to move fast, but don't break things. You're going to hear that quite often as we go forward at the inflection point. As part of managing risks and understanding that the digital environment, product service offering, whether you're a software developer, whether you're an end user, it's not the paper world. People want to say, oh, it's easier, it's faster, it's better, you can just push buttons, but you can't think that way. We're in the West, it's not the Wild West, laws and regulations, still apply. You're going to need to think about authentication risk, attribution risk, authority risk, compliance risk, I'm going to list them all, enforcement risk, repudiation risk, it's not me, admissibility risk, can the evidence that you need to prove up the transaction that you're trying to defend, do you have a chain of custody, what do your audit trails look like? You need to think about all these things and make sure that your platforms are doing the task. The consequences are clear, they're a long list. Also, you can have unenforceable transactions, loss of negotiability if you're in financial services, or devalued assets, liability for unauthorized transactions, choice of law problems, loss of IP, loss of control of data or ownership of data. Data monetization is a great opportunity if you don't, you put it in the contract, but if you have the contract in an electronic environment and you don't have the right authority, or it's not the right person, it's a deep fake, what have you, you're not going to have an enforceable contract. The courts are clear, they're finally catching up, and they're saying contract law does matter in an electronic environment. You're going to have class actions, enforcement actions from the alphabet soup of federal regulators. You'll call Isabelle for state AG claims. There are a lot of consequences here.
And I'm sure it comes as no surprise to any of us that AI was a huge feature in our disruption survey. We surveyed people around the world. Everybody's very excited about AI. Nobody's quite sure what to do about AI. There is no regulatory framework. There is no regulatory guidance. That is a consistent trend throughout the jurisdictions. There are the beginnings in a number of different places of regulation. One of the challenges is that the regulators themselves don't fully understand the technology. It's like the old fintech days when people are trying to figure out how do we balance the enormous potential here against the risk and the fact that we just simply don't understand where this technology is going to go and what it means to be responsible about using the technology. So the financial services industry, and I think more broadly, people recognize that that is the challenge. Over 50% of our respondents said that they see use of AI as a major challenge, and 1 in 10 said it is the most critical issue facing their organization. 74% of our respondents said they do not want to be a market leader in this space, and that's really interesting. Instead, they would rather see how things develop and let somebody else get out there on the cutting edge first, or they're only going to make a move when their stakeholders require them to do so. But that doesn't mean that they're doing nothing. 40% of our respondents said that they are investing in internal expertise and training. 64% are investing in the technology, and over 50% are already actively developing their ethical frameworks. So this is coming, but at different speeds depending on where they fall within the framework. Some of these folks are what we call fast followers. They don't want to be the first one, but they certainly don't want to be the last one either. They're trying not to be the one that forges a path for others to follow, but not to be left behind when the technology is ready for prime time. Where are they using the technology now? Definitely in the spaces of fraud detection and prevention, for operational efficiencies, for customer service, and some of you have definitely interacted with an AI chatbot before, and that's what they mean by that. And in the wealth and management space, there is a move toward automated investments. So lots going on in the space. And again, as we saw with the ESG, it's another time that all of a sudden the industry is asking for more regulation. And that's consistent whether it's here in the United States or in other places. We know that the White House has already produced a blueprint for an AI Bill of Rights. The banking regulators are in the space. They're thinking about it. They have the additional mandate of considering, of course, the stability of the financial system and the economy and not stifling innovation at the same time. So that is very much up and coming. Again, California is in the space. There have been a number of pieces of legislation, not all of them successful, that have recently come through the California legislature. And I think California will continue to be a leader in this space, but more guidance is needed. And of course, into this space of uncertainty come the plaintiffs' attorneys. They always do. They're grappling a little bit with this. They don't understand the technology either. They realize there's an enormous opportunity here, but they haven't quite figured out how to do it yet. Some of the early cases that we've seen have been in the chatbot space around privacy issues. There's also been a lot of litigation, particularly here in the Northern District, on the intellectual property side about using data sets and what your rights are and where that information comes from. That is the very, very beginning. When we have this conversation again in a couple of years, things will have materially changed by then, I think. Where will it go? Certainly some very interesting issues in the privacy space about the use of technology. I think most privacy class actions in the future will have some component of AI as a part of them. There may be securities litigation. It could turn out this is more of a product liability type conversation. This may be something that flows in the direction of more of a kind of traditional breach of contract discussion. It could be all of the above. So a space to watch for sure, and stay tuned. I do think in particular for AI and machine learning, the beginning of the litigation is here and it will only continue to grow, particularly if there's kind of a one-off event or something specific that needs to be addressed. One more area to flag, and that's in the SEC space. There's now something called AI washing. You don't want to be representing that your technology does something that it doesn't, or you shouldn't be telling people that you're using AI if you're not.
And then regulation. Regulation is a double-edged sword. Too much, too little. A key reason for those survey respondents who were trending pessimistic about the growth was excessive regulation. 89% has a concern with excessive regulation, with more than half of the respondents believing there's no greater challenge to a business than complying with regulations. There are a number of regulatory changes that we're going to talk through here quickly. The dual banking system. As you know, laws and regulations for licensing, chartering, product regulation, and enforcement exist at both the federal and state level. While this duality was meant to foster innovation and competition among providers of the services, it's also resulted in regulatory competition, blurred jurisdictional lines, overlapping jurisdictional lines. And this is impacting the slower rate of digital transformation, and especially in the blockchain and digital asset space. More to come on that next year, but we may be moving in a good direction there. But it's definitely slowed down the rate. The upcoming election, this is probably worth saying. You know, we have an election maybe next week, 2 weeks, 3 weeks. It's clearly going to impact the conditions just discussed. The possible financial futures will be influenced by these outcomes. Harris wins, Trump wins. Single party control, divided government. Whichever party controls the Senate controls the nominations and the ability to consider legislation. So everything that we're talking about today is a little bit on hold until about 3 weeks from now, and maybe even longer. We'll see how that plays out in the courts. Financial regulators will be more proactive under a Democratic president. Policy differences among the two administrations could make a difference in bank mergers, capital requirements, consumer finance, non-bank regulation, and in crypto. And last thing, the known impact of the Supreme Court ruling overturning the Chevron deference doctrine in the Loper-Bright case. The result of that decision will likely increase challenges to federal regulations, may cause agencies to go a little bit slower, and may cause Congress to be also a little slower and a little bit more precise. So those factors yet to come to impact, where we are.
We are the last thing between you and lunch. So we will just commend to you our report. It should be linked to the materials for this conversation, and it's also in the app. So feel free to download it and see some of the additional information there.